Hey everyone, I'm Daniel Snyder from Seeking Alpha. Thank you so much for tuning in to this video. We know that there is a lot of uncertainty in the markets right now. We are recording this on March 31st, so hopefully you're going to see the timeliness of these picks that Steve is bringing to us today. But before we dive into these top 10 stocks for April, let's go ahead and get a quick legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment security or strategy or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by by future events. Excuse me on that. It represents my opinions and Steve's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed security dealer, broker, or U.S. investment advisor or investment bank. And with that out of the way, Steve, for some reason, that word always gets me. I don't know why. It always gets me. But
you got us there that day. Thank you so much. Thanks for arranging this today. I think it's very, very timely.
It's extremely timely. Like I said, there's a lot of uncertainty. So who better to talk to than yourself? I'm going to go ahead and let you take it away.
All right. So I am the head of quantitative strategy at Seeking Alpha, and I have about 35 years of experience in financial markets. So I've seen quite a bit of turmoil in my time. And one of the reasons I'm really pleased that we're doing this presentation today is usually when you have market pullbacks, there's a certain period where stocks start to look interesting. And I believe we're close to one of those pullback periods, especially off of the NASDAQ, where we want to start looking at some stocks. So, Daniel, I really think this was timely, and I appreciate you pulling it together. Today's presentation will cover why quant. It will also cover 2025 tariff turbulence and a macro overview, as well as our top 10 quant stocks for April 2025. So going a little bit into our quant vision, and I think what makes it very interesting is one of our goals from quant is to help eliminate emotional investing and uncover top stocks using data-driven tactics. And I probably should underscore emotional investing because right now people are very emotional. You've had fear driving the market. Sentiment has been very negative. It's come off sharply really since February when we had the S&P 500 high. The NASDAQ high was actually back in December, and we've had a major rotation out of what had been very strong fundamental stocks into typical safe havens. So indeed, emotion is driving the market right now. But as a quant, we try to avoid emotion. So we stick with what our strategy is over a very long period of time has worked out quite well. So what is our quant strategy? One, we believe it's time tested. At Seeking Alpha, I back tested this to 2010. But as I mentioned, I've been in the markets for a long time, and I've been in quant for since 2020. So almost 25 years of experience in quant itself. The strategy that we employ at Seeking Alpha from a quant perspective could be known as what is called GARP, growth at a reasonable price. We have a couple of other things that we look at with our strategy. So we actually try to identify stocks that are collectively strong on value, growth, profitability, EPS revisions, and momentum. And what we do with quant and what makes it such a powerful tool is that we can actually look at all those factors and many, many underlying factors, as well as cash flow statements, balance sheets, income statements on a daily basis. And we run it through a very powerful computer model. And it gives us the ability to look at each stock with a fresh perspective every single day. So one of the beauties about quant is you're getting that fresh directional recommendation. Whereas if you went to a conventional research report, maybe from Morgan Stanley or Merrill Lynch or Goldman Sachs, that report could be 2 weeks old, 4 weeks old, 2 months old. So it makes it kind of dated. And from my perspective, if you look at a research report that's 2 months old, that's kind of like looking at a newspaper story from 2 months ago. It's really hard to make an investment decision on that. So really the power of quant is that we crunch the numbers every single day to bring you a fresh directional recommendation. And when we do it, we're looking at a company versus all the other companies in the sector. So this way we can basically strip out the strong companies from the weak companies with our scoring system. And we have a pretty good track record. This is our track record over the last 5 years. The back test actually goes back to 2010, and it's very strong performance. But just over the last 5 years, you can see the strong buys for quant are up about 200% versus the S&P 500 on the far right, which is up about 66%. And if you were to look at professional Wall Street analysts and their strong buys, that's up only 38% over the 5-year period. So quant clearly demonstrating it's been very, very powerful over the last 5 years. And the reason why I show this is not to say this is an investable model that we have. We don't have an ETF or a mutual fund at Seeking Alpha. What I really just want to do here is demonstrate that our GARP strategy works. And what we do is we take every strong buy that we have every single day on a daily basis, and we basically put it into a portfolio, and we rebalance that portfolio on a daily basis. So once the stock drops out of the strong buy territory, it comes out of the portfolio. Hence, this is very transparent. There's no cherry picking of certain stocks. It's all the quant strong buys. So you can see we clearly have a very, very strong track record. So I want to get into the markets a little bit on what's going on. Obviously, an incredible amount of volatility, and it has led to what I refer to as the great rotation this year. So if we just, by way of background, look at the last couple of years, 2023 and 2024, the market was really dominated by the Mag 7 stocks during that period. In 2023, the Mag 7 stocks on average were up 111%. And it was occurring during a period where we had interest rates going up, inflation was increasing, and we also did have the AI revolution. And those three characteristics are really quite attributable to driving the Mag 7. The Mag 7 almost was a defensive sector where people typically, during periods of uncertainty of inflation and rising interest rates, they might go to more conventional safe haven stocks, and they did. The Mag 7, those are the largest 7 stocks in the S&P 500. They're the most profitable companies. They have dependable earnings, and they have a ton of cash. So during that period of uncertainty in 2023 and 2024, the Mag 7 attracted a lot of investors. Also, we were really, at the doorsteps of AI, and these companies are all very big in AI. Going to 2025, the markets had a lot of volatility. So something that we didn't really talk about at all during 2023 and really 2024 were tariffs. Now tariffs are front and center. They've created a lot of economic uncertainty. With the new administration, there have also been a lot of executive orders and a changing regulatory environment that's fostered many market gyrations year to date. So far, year to date, the Mag 7 are actually down on average 6.7%, and the S&P is down about 5.54%. So the Mag 7 is actually underperforming. But that's not an unusual thing because in 2022, the Mag 7 really underperformed the market a lot during that period. So we're getting back to a period where people are looking at the Mag 7 and their earnings. And what we're seeing is that the year-over-year earnings growth for the Mag 7 stocks were actually stronger than the forward growth rates. So we've come into a period where earnings are not quite as strong on the Mag 7 as they had been. And this is where we come to sort of a normalization for 2025. Since February 19th, the S&P has pulled back roughly 10% from its 52-week high, which was about 40 days ago. And the NASDAQ is down about 15.3% from its high about 105 days ago. As I mentioned, the concerns are roughly around the tariffs, inflation, corporate earnings deterioration, as we've seen with the Magnificent Seven, and looming recession fears have all contributed to these market pullbacks. On the back of these fears, investors have really taken profits in many good companies that have performed well, that had very, very strong fundamentals. And this is what happens when sentiment and fear drive markets. People sell stocks where they made money. They sell stocks where companies have beat expectations on a top line, bottom line basis. It almost doesn't matter how good the company is. When the fear factor is in the market, it's a flight to safety, and people rotate to conventional stocks such as utilities, consumer staples, cash, and even gold during periods like that. Markets aren't looking at fundamentals. They're being driven by fear and sentiment. So I think if we looked at our sector rotation year to date, on the far right side, you'll see energy has popped up, and that's actually just recently, hasn't been performing well. But we've had healthcare, which is a traditional defensive sector, up 5%, utilities up 3%, consumer staples up 2.2%, and financial services up about 18.2%. If you look at the bottom on the far right side, you can see the sectors that had performed so well over the course of last year, consumer discretionary and technology, industrials and communication services are all down year to date. So the sectors really that had done well over the period of the year have flipped year to date, and we've seen that flight to safety. If you were even to look at today's rotation, the market, as Daniel mentioned, it's reported the market is up today, but even with the market being up, people are not moving back into the technology stocks. They're even making a further move into consumer staples, which is up 1.72%. Real estate, which also does well during periods like this. Utilities up 1.2%, and energy up 1.2%. If you go to the bottom of the list, and again, this is for March 31st, technology was an underperformer, consumer discretionary flat, and communication services up a little bit. So even with the market up, we're still seeing that flight to safety occur. So as I mentioned, the things that are driving the market, we have the trade tariff wars, which are just starting to occur. Higher prices could reduce consumer spending. Obviously, when inflation happens, people want to tighten the belt and they don't want to spend as much. Ultimately, that could lead to potential slowdown in economic growth. And if you look at the chart on the right side, you can see what a massive move there's been in consumer confidence from November to March of 2025. That is a huge delta to go from 111 to 92.9 in such a brief period. So it really shows you that consumers are concerned. And it's not just consumers. On a corporate level, on a C level, many corporate executives are concerned too. And the amount of spending that they were going to do in CapEx has been slowed up a little bit. So it's not that their earnings and revenues have been weak. Many companies are coming off a good period of top line growth and earnings growth. It's that they're concerned and there's uncertainty about how the tariffs are going to be impacting the consumers and their companies. So we're seeing consumer confidence slip on both an individual level and a corporate level as well. And in fact, the March U.S. consumer confidence number hit a 12-year low. That's its lowest level since early 2021. We've also seen the federal government cutting costs as well. We all know that the federal government is bloated, so it's probably not a bad plan, but it just seems like it's coming across very fast, probably faster than most people expected. So that's creating some uncertainty. As I mentioned, we've had a corporate earnings deterioration, and we still have inflation sticky at this point. It's not really come down to the levels that investors would like to see or economists would like to see, and this is pre-tariffs that we're seeing that. Having said that, interest rates did come down several times in the late portion of last year, and interest rate traders are looking for rates to remain unchanged in May and come down slightly in June. But the Fed is really taking sort of a wait and hold approach to what's happening. So what I prepared here is we've heard the word tariffs a lot over the last 8 weeks. And I put together this chart to show what happens in the first year that tariffs are launched, going all the way back to 1930 when Herbert Hoover was president, and he helped to introduce the Smoot-Hawley tariffs. So as we know, the market had a correction in 1929. Smoot-Hawley tariffs were introduced in 1930, and the market actually came off in 1930 a further 28.5%. The recession really had started, you could say, in 1929 at that point, but it progressed to get much worse and obviously rolled into a depression after the Smoot-Hawley tariffs. It had such a big negative impact on the economy on a global basis that there wasn't another president until Richard Nixon in 1970 who laid out tariffs, and that was referred to as the Nixon shock. The tariffs then were relatively light, so it really had a very minimal impact on the market. However, pre-1970, the market did start to go into recession in 1969, and it did get worse until 1973. There was a brief reprieve, and then the recession continued again until 1975. When George Bush was president in 2002, he had steel tariffs, so it was pretty limited. Where I should say the Smoot-Hawley really were global tariffs. The tariffs from George Bush were very limited to one industry, was steel, but it had a big impact on the market. The year he launched that was 2002, and the market fell about 23.4%. Again, the recession really started a year early in 2001. So it's not just the tariffs that are responsible for these recessions. As you can see, in many cases, the recessions were starting the year before. It's just that tariffs don't help, and it certainly does not help the markets. And even when Donald Trump was president, he let out some tariffs for China and steel tariffs as well in 2018, and the market declined by 6.2%. The recession year started in 2020, but obviously we had the pandemic. So again, it's not that the tariffs themselves were responsible for these recessions, but the markets typically don't like it. On average, during those 4 periods of tariffs, the markets were down about 14.5% for the S&P 500. So turmoil does bring opportunity, and this is what I want to highlight. We're now at a period where the S&P 500 is off about 10% from its high 40 days ago. The Nasdaq is off 15% from its high back in December. So it's actually, when you start to see numbers like this, even though the markets could fall further, it does pay to be a little opportunistic. So taking a cautious step into the market during periods of turmoil could present an opportunity to capitalize on market weakness. And as I mentioned, we've seen the rotation occur already. Investors have already pivoted towards global stocks out of the US. They've pivoted into defensive sectors and safe havens amidst this market turbulence. So the reason why we want to highlight being opportunistic is there is something that usually follows when stocks start to trade well again, and it's called the fear of missing out, FOMO. So while global stocks and defensive sectors can help hedge against market volatility, investors don't necessarily want to be 100% defensive, because if they are, they miss out on the upside of stocks that have excellent fundamentals. And that's what we're doing today, is we're bringing forward stocks that have excellent fundamentals. Many of these stocks have sold off already, some far in excess of the markets. But one thing that is consistent is that the fundamentals for these companies remain very strong. And history will show you, and the chart that I will provide on the next page will display that since 2010, Seeking Alpha's quant top 10 strong buys, if you had bought those stocks off of the last 5 pullbacks where the market corrected by 15%. So we're actually there with the Nasdaq. We're not there with the S&P 500. But when the S&P historically had pulled back 15%, if you had bought the top 10 quant strong buys and you held on to them for 2 years, you would have had a return of 117%. But the other thing I'll add to that, even if you bought the S&P 500 when it had pulled back 15%, if you held on to the S&P 500 for 2 years, it was up close to 50%. And that's what the next chart will demonstrate. So if you look on the right side, you can see since 2010, following 5 pullbacks of 15%, SA's top 10 quant stocks surged 117%. So it significantly beat the S&P. But I have to say, a return of 50% from the S&P is not bad either. It's just you're getting a much better return if you focus on stocks that have good fundamentals.
Hey, Steve, real quick, just to make sure we clarify this chart. I know somebody's watching this video right now and they're going, wait, is that 117% since the first time it pulled back, or is that after every single pullback?
That's an average, Daniel. So that's looking at the, so in order to sort of limit the chart and not have it that extensive over a period going back to 2010 and highlighting each period, we took the average. So this is, if you took the average market return, if you had purchased the top 10 quant stocks, as well as for the S&P 500 during those 5 periods, if you held on to it for 2 years, the average return is 117% for the quant stocks and almost 50% for the S&P 500. So we sort of averaged that from the 5 pullbacks. So as I was saying, fear is what creates losses. Panic selling during market downturns obviously could lead to financial setbacks. So if you're looking at the markets now with the S&P already down 10% and the Nasdaq down 15%, and this is when your fear factor is kicking in and you're deciding to liquidate everything, this is probably not the time to have done it. The time to have done that would have probably been in December or January or February. At this point, we're looking at a market that is down. And even if the market were to go down 20%, it's hard to catch a falling knife. And that's why we use this point of a 15% pullback. So we don't know if the market's going to be down 10%. We don't know if it's going to be down 15. We don't know if it's going to be 20. But what we can demonstrate is when the market is down 15%, and as I said, the Nasdaq is already there. If you wait for a 2-year period, it's pretty good. So there are a couple of people that have just as much experience of me, if not more. And I wanted to sort of quote those individuals. So you're not just hearing this from me. We actually have one contributor. His name is Colin Roach. And I really like this saying that he has. He said, the stock market is the only market where things go on sale and all the customers run out of the store. And it's so true. Because if you were in Nordstrom or if you were in Saks Fifth Avenue or Bloomingdale's and you had sales like this, people would be buying up merchandise. But if you're in the stock market and things go on sale, people run for the doors. So to use a couple other quotes, Peter Lynch famously said, and he's one of the most famous investors of all time, right up there with Warren Buffett. He said, the key to making money in stocks is not to get scared out of them. And this is the exact type of period where people will get scared at. And of course, Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. So we're not necessarily telling you to be really greedy here and take all your cash and put it back into these top 10 recommendations. What we're saying is to start acquiring some of these stocks on the pullback that they've had. And something that I always say is fear fades, the market always returns to fundamentals. So when you have periods of fear and negative sentiment, people will fly out of stocks, but eventually, and you could just look back to the beginning of history, people will always return to fundamentals and they'll make sound investment decisions once that fear fades. So without further ado, I will give you our top 10 stocks for April 2025. The list is a little bit different than you'd have seen in January, but some stocks are similar. One stock is AppLovin, ticker symbol APP. It has a market cap of $92 billion. It's a quant strong buy at this period. It's in the IT sector. And within the IT sector, it ranks 4 out of 542 stocks. And within its industry, which is software application, it ranks 2 out of 192 stocks. It's a cloud-based ad platform that allows app developers to profit via ads with upfront fees and within app purchases. And the company has had a really stellar period. Revenue growth year over year is up 43% versus 5%. EBIT growth is up 189%, and leverage free cash flow year over year is up 61%. Now, there was a company that issued a short report, and there's actually been several that have put short reports out. And typically, this happens when you have a stock that's a high profile stock, these short report companies, and this investment research for the name of it is Muddy Waters. So not really one of your tier 1, tier 2, or even tier 3 investment research platforms. They issued a short report. The stock reacted negatively to it. And whenever you have a stock that's usually up, 1, 2, or 300%, sometimes these short reports can have a big impact. But if you look at the quality research firms like Morgan Stanley, Merrill Lynch, Goldman, in the last 90 days, 19 analysts have moved their estimates up for the company, and only one has moved it down. And in fact, I saw earlier today, Bank of America was reiterating their AppLovin as one of their top picks. And it's interesting. You look at his face and he's like, "Ooh, yeah, Joe,
brave call." You got a great shot here, Joe. Man, he's
I know, right? He's like, brave call by Bank of America. But they're reiterating it, and from a quant perspective, we're reiterating it. We haven't seen any analysts reduce their numbers on the company. Just one has taken it down, and the company tends to be very consistent with what they're saying. So I really take what the short reports have to say with a grain of salt. Another company that looks great is Brinker. This is a $6.5 billion company. It is a quant strong buy. It's consistently been a quant strong buy, and it's proven to be very successful for us. It's in the consumer discretionary sector, and it ranks 3 out of 42. And within its industry of restaurants, it ranks 1 out of 43. They had record results for Q2 in 2024, which was fueled by high foot traffic, which is exactly what you want to see. They had new menu items, and they've done very, very well on social media. They've also had the ability to lower their food costs in the second quarter, despite inflation impacting many other restaurant companies. In terms of their PEG basis, which is one of my favorite ratios, it's 0.47. So from a valuation framework, looking at PEG, which combines both PE and growth, it's at a 65% discount to the sector. The forward EPS growth for the company is 60%. And what I'm going to do is I'm actually going to take us into our platform to show you what that looks like. So we're actually on the Seeking Alpha platform now. This is the stock page. And you can see the quant strong buy there. In the last year, the stock is up 192%. And year to date, the stock is up 12%. And if you look at the last 6 months, it's up 94%. And the reason why I'm pointing this out, the stock was up 94% in the last 6 months. But if we go to the far right and we look at the valuation is actually better on the company now than it was 6 months ago. So the current valuation grade is C plus. 6 months ago it was C minus. So it was actually a tad more expensive 6 months ago. And 3 months ago it was a D plus. So the valuation is actually more attractive now. As you can see, the stock has come off since February, and that's one of the reasons why the valuation is more attractive, but it's really at the same valuation levels. If you look at the growth for a company, the company now, it's an A grade versus the sector. 6 months ago, it was only C plus. So you actually have stronger growth now. You have a better valuation framework. So the fact that the stock is up 94% in the last 6 months or up 192% in the last year is irrelevant because it's actually a better valuation framework and stronger growth now than it was then. So I just wanted to point that out, and that's why it's ranked number 1 out of 43 stocks.
Hey, Steve, real quick, mind going to the quant history here for the last 3 years? I think this is a really good stock actually to point out that the GARP approach works. Because if you go to the 3-year history, I mean, it takes it back to, the COVID hit there on the left side. Yeah. You see the hold and then you see the sell. But really, I mean, look at that. Nailing the buy rating on the shift right before the raise in the momentum. I mean, this is incredible.
Yeah, it just had gone from, it was about $35, $34 back in November of 2023. And that's when Quant picked up to it. And what's really nice about this page, Daniel, is actually like when I highlight on it, you can actually see where the Quant grades were. So the valuation was a B minus. You can see the growth was a B minus. So the growth today is an A grade. And remember, our factor grades are all sector relative. So when you're looking at growth or valuation, you're looking at it for the company compared to the sector. So it's on a sector relative basis. You can see growth back then in November of 2023 was a B minus. Today it's an A. If you look at profitability, back then it was a C minus, and today profitability is an A plus. So the company, even with the huge move that it's had on its stock price, it's actually much better position in terms of value, profitability, and growth than it was back in November of 2023. So I'm glad that you pointed that out. We're very transparent at Seeking Alpha. We show, as you can see on these rating pages, every single day, we show you what the quant rating was, what the valuation grade was, growth grade, profitability, momentum, EPS revisions. So it's all right there, very, very transparent as well what the stock price was. So I'll take us back to our presentation, and I'll enlarge it so those who are looking at their phone will be able to see it. The next company, which is many of our subscribers are familiar with, is Celestica. This is a company out of Canada, CLS. This company had a great period. Up until recently, the stock has come off, and this is one of the companies that is one of the biggest losers in stock price recently, but has just excellent grades. It has a quant strong buy. It's in the IT sector. It's 8 out of 542 stocks. And the industry is electronic manufacturing services, where it ranks 1 out of 16. It is a leader in supply chain solutions, and is one of the largest electronic manufacturer services, and it had one of Canada's biggest IPOs. Now, I know there's a lot of back and forth with tariffs with Canada now, but that's going to be on a global basis. So it's going to be normalized into companies' numbers, whether you're Ford or General Motors or Celestica or Toyota or SAP or British Tobacco. The tariffs are going to be factored in all over the place. So it's going to become normalized. But this company and the demand for their products is just absolutely stellar. It's actually been one of our top Alpha Pick stocks too. It's up 180% since we put it into Alpha Picks in October 2023. And on a PEG basis, it's at a 61% discount to the sector. So we really like Celestica here. Lifetime Group. Now, this is a new name that we've brought forward. But this company is really interesting. The market cap on it is $6.6 billion. It's a quant strong buy. It's in the consumer discretionary sector, and it ranks 5 out of 482. Its industry is pretty limited. It's 1 in its industry on a ranking out of 8. But this is a fitness facility. It's a leisure fitness facility. I'm actually a member myself of Lifetime Group, and I could not speak highly enough of their clubs, the services, the products that they offer. It's just like really an incredible facility. And people who do want to be healthy, they go there. They have everything from swimming to paddleball to squash to incredible weight facilities, lots of classes. And I think people who go become very, very loyal to this. It's very, very sticky. They're just really all over the country now. They're executing on a large number of sale leasebacks as well to fund their expansion. The stock has rallied 80%, 87% in the last year. But you can see if you look at the far right side, the growth, it's an A minus now versus the sector, and it was an A minus 6 months ago. Valuation grade is actually a little bit better now. It's a D plus. 6 months ago it was a D minus, so it was actually more expensive 6 months ago, despite the stock moving up. So its earnings growth has really kept pace. The company is moving really in terms of its profitability. You can see 6 months ago it was a D. Now it's a C minus. But analysts really like the company. They keep revising their estimates up, and the momentum has been very strong. Lifetime Group could not speak highly enough about it. Palomar Holdings, ticker symbol PLMR. This is in the financial sector. It's a property and casualty insurance company. Within its industry, it ranks 2 out of 50 on our SA ranking. It's quite a small property and casualty insurance company. They've been capitalizing on their long-term returns and serving as a hedge against inflation, which has worked out quite well for many investors. I last wrote about this stock in April of 2024. And since April 2024, the stock is up 82%. But again, I'm going to go to the right-hand side here, and you're going to see that the valuation is actually better now than it was 6 months ago. The growth grade is the same that it was 6 months ago. So despite the stock having that rally, the valuation picture looks a little bit better. Growth is the same. Profitability is about B plus A territory. Momentum is stronger, but analysts are actually liking the company more now than they were 6 months ago. It's an A plus rating for analysts in terms of the last 90 days moving up their earnings estimates versus 6 months ago where it was a B plus. The next is a Japanese company. So we're offering a bit of diversification here today. You'll see some IT companies, some consumer discretionary, some financial, some consumer staples. Tokio Marine Holding is actually a financial company as well. It's a property and casualty company based out of Japan, ticker symbol TKOMY. It is a huge company. It's got a market cap of $77 billion. And within its industry, it ranks 5 out of 50. As I mentioned, the company is headquartered in Japan. It's been coming to light as we have seen a Renew initiative, which is focused on its next generation of risk solutions, which is combining insurance and alpha by increasing customers and their value and improving on their loss ratios. The PEG on this company is 0.15 versus the financial sector at 0.63. So it's at a huge discount to the sector. And I'm going to show you as well. And actually, I'll take you to our platform. One of the reasons why I want to highlight some international stocks here today is if you look at the performance on international stocks year to date, you can see they've been doing incredible. So for basically the last decade, the U.S. has been the show. But because of what's going on, there's been a flight of capital out of the U.S. into some other markets. But also the valuation framework looks really very cheap in many international markets. And in certain cases, we're seeing some good growth. So you'll see countries like Poland are up 36%, Greece up 24%, Spain up 23%. As you just scroll and you go down and down and down, you'll see there are many countries that have returns that are in the positive domain this year. Then we get to the U.S., it's down about 2.63%. So I'd say after the last decade, there's really been a large economy disconnect between the U.S. and the growth in foreign markets. But we're now starting to see basically a flight to many of those foreign markets. So that's why I like to have some diversification, especially in periods of uncertainty as we're seeing now. So I'm happy to recommend a couple companies that are not U.S. centric. I'm going to blow up our slideshow again and take us to Sea Limited, which is a communication services company. This is another big company. Market cap is $75 billion. Within the interactive home entertainment sector, it ranks 1 out of 18 stocks within that industry that we cover. Again, this is a foreign company. They're based out of Singapore, and they're known for their digital entertainment brand, Garena, and their e-commerce, Shopee. They also have a fintech company called SeaMoney. The stock is up 140% over the last year. And as I will point you to the right-hand side, so you can look at those factor grades, you can see the valuation now is actually better at D plus than it was 6 months ago when it was a D. The growth for the company is a tad better too at A plus than it was 6 months ago. Profitability is about the same. Momentum has been A plus all along, and analysts continue to like the company, taking their earnings revisions up. So this company, again, based in Singapore within communication services. And we haven't, believe it or not, Amazon. You normally don't hear me talking about any of the Mag 7 stocks, but Amazon is actually a strong buy right now. Historically, we have seen the valuation grade. If you look to the far right, it's a D plus now, which actually puts it in a range that is permissible for a strong buy. Historically, we've seen this as a D minus or even an F, and it's just too expensive for our model to like. However, the current valuation is a little bit more attractive. The growth remains. It's an A minus now, was an A minus 6 months ago. This is, of course, one of the most profitable companies in the globe, so it has an A plus. And you can see if you look down, analysts are still positive on the company, taking their earnings estimates up over the last 90 days. And this stock has actually gotten pretty hammered over the last couple months. So people are very familiar with this. It's a broadline retailer, and it currently ranks 2 out of 27. And we normally don't have that kind of ranking because the valuation is just too expensive. They had a strong Q4 result coming in with $1.86, beating expectations by about 38 cents. And of course, their AWS data centers are benefiting from advancements in AI as well. If you look at the valuation, specifically at the PEG ratio, again, a combination of PE and growth, it's at a 46% discount to the sector. And coming in at number 2 is a consumer staples company, CCU, which provides diversified beverages. Many people know it for their beer beverages. This company is headquartered in Chile. In the industry of brewers, they actually rank 1 out of 7. And within the consumer staples sector, it ranks 5 out of 183. It does trade on the New York Stock Exchange under the ticker symbol CCU. They operate in 3 segments, Chile, international businesses, and wine. Year-over-year growth for the company is 2% versus consumer staples at 2%. EBIT growth has been 8.45% versus the sector at 5.7%. And ROE growth is 8% for the company versus the sector at 0.04. So tremendous difference to the sector for this consumer staple company. And again, my favorite valuation, PEG, at 0.33, it puts it at a 64% discount to the sector. And the number 1 recommendation we have here is Taiwan Semiconductor. So this stock taking a little bit on the nose since February as well, but it ranks number 1 out of 68 semiconductor companies that we cover within the IT sector. It is 10 out of 542. Many people are familiar with this company as a global leader in the manufacturing, packaging, testing, and sale of integrated circuits. Over the last 5 years, the stock was up 240%. And of course, it's been benefiting on the back of tech and the AI boom as well. Revenue growth was very strong for the company. Year over year, it was 33% versus the sector with just revenue growth of 5%. EBIT growth for Taiwan Semiconductor was 44% versus the sector at 10%. And leverage free cash flow, a whopping 732% compared to the sector at only 15%. On a PEG basis, it's at a 63% discount to the sector. So again, we have a good diversification here. I think we have 5 different countries. We have 5 different sectors. But that's kind of what you want when you're in a period of market turmoil. But the common thread with many of these companies is just like outstanding growth. So on this next slide, you'll see the name of the companies and the sectors that I mentioned. We have 5 countries, 5 different sectors. But what I'd like you to look at is the EPS growth. And you can see the tremendous EPS growth, the forward growth rate for these companies. It is significantly higher than the S&P 500. And the valuation, once you sort of average it out, it's better than the sector as well, too. So, but better than the overall S&P. So we have some great numbers here. And something else I want to show you is actually if we go to this portfolio, I'm going to take you to the earnings page. on the portfolio. And you can see we've been in the earnings season. So I'm going to click on this. And this, you could sort by a number of things. You could sort it by the revenue estimate, EPS estimate, actual review. So right now, we're sorting by the last quarter announcement. And you can see of these 10 companies, all of them beat top line, and 9 out of the 10 had beat their EPS expectations too. So that means is the companies actually came in with earnings that were better than analysts expected. And the one C Limited was the one that was just a little bit shy. It came in just off 10 cents, but its actual EPS was 60 cents, so not that bad. But on a top line basis, they actually beat their revenue. So these companies looking good in terms of their fundamentals with their top line growth and their bottom line growth. And again, we're at a point where the S&P is not down 15% yet, which is usually a period that I do like to go in and start recommending that people add to positions. But you do have the NASDAQ down 15% at this point. So Daniel, thank you very much for your time. Again, a lot of turmoil in the markets, but we're starting to hit those points where it is worth putting your toes in, and we're looking for companies with good fundamentals. We ignore the sentiment, we ignore the fear, we ignore what talking heads are saying. We look at the data, where we have a data-driven process, and the data tells us that these companies have good fundamentals, but we know the stock prices have come off quite a bit. We also know if you just pay attention to fundamentals and you can ignore that noise, over time you will be rewarded. Daniel, let me open up some questions.
Yeah, Steve, I can't help but think, I mean, this was all phenomenal, but I can't help but think we've been doing videos like this for years, me and you, and we have always had it come up time and time again in presentations of valuations matter. No matter what the market is doing, valuations matter. And it can be easy to lose sight of that sometimes, especially when we're on a risk on, growth is taking off, tech is taking off. So first off, just want to say thank you for being that steady ship for us to remind us that valuations matter and laying the land there for us as well. These 10 stocks actually are really incredible to see you go through from US and abroad, because we don't talk about abroad, honestly, enough. But the first thing we got to talk about.
I got to say, Daniel, actually, it's, part of the reason I've been, when you go to the quant screens, you do normally see a lot of international stocks up there. They have really good fundamentals, but, much of our client base likes to look at US stocks. So over the last couple of years, I've been catering to our audience, especially like when we've had top 10 stocks. There have been very few recommendations outside of the US, but clearly we're in a period now where you're seeing that diversification, not only into the sectors, but into gold, into cash. And as I showed you, the returns, we're seeing in a number of equity markets throughout the world, they've been absolutely enormous. So investors are actually discovering there's growth outside of the US that's stronger growth than we have in our US companies. And there's valuation frameworks that are actually better than US companies. So that's why we're seeing so many of these foreign markets light up. So these companies are in the quant model, and I think now is a good period to sort of bring it to people's attention.
I couldn't agree with you more. I mean, there's many ways to make money in these markets, right? So that's the best part about it. First thing we need to talk about, though, question for you, is we're discussing the tariff environment, right? And it seems like it's changing and evolving every single week. The question is there a way for somebody to look at the quant model data and try to get a sense if a company and their portfolio might be affected with tariffs and how management thinks about what is implemented?
We put out an article not too long ago on companies that could be a safe haven from tariffs. So typically the safe haven companies are ones that don't have exposure to their supply chain being outside of the US. They make their products from resources that are in the US or their services that they provide in the US. So to a certain extent, those companies provide a level of protection from the tariffs. But it's a global world. And, even if they're, a company that is a hotel company, eventually some of the things that they buy, whether it's cleaning supplies or food supplies, there's going to be something coming in from foreign countries. Even if you look at WeatherTech, it's, their products made in the US. It's a great company, US employees, they're still going to be impacted. The cars and tariffs will be impacting those. So it could impact them in a positive way if people are buying more, but they're buying older cars, pre-used cars, pre-owned cars, whatever you want to refer to it. They might want to spruce it up a little bit with WeatherTech. So not that you can go out and buy that stock, but there are examples of companies that are are to a certain extent isolated from the tariffs. So you could look for those companies, and I'd say just go to the screens. We'll highlight that report as well. But it is pretty difficult to escape tariffs. It's difficult to escape the inflation that tariffs bring. So whether you're purely domestic or not, escaping those tariffs and the inflation that's created by it is almost impossible.
Well said. Well said. So, follow up question for you here. The revisions that we're starting to see in the headlines, we see the shops, whether it's Goldman or UBS, people are starting to come out and refine their year end targets. But we know we have the EPS revision factor grade within our quant system for individual stocks. When investors are watching that grade, is there any kind of time frame that they should be looking at? Typically earnings, right? I think about you had mentioned earnings, and I know Taiwan Semi is coming up again. Should an investor go and start looking at that grade every day to see if analysts are revising their estimates and maybe get a clue from that?
So that's a great place to get a clue. And remember, one that's revised every day. So we update that every day, and that is forward looking. So our model, it's historical looking and it's forward looking. From a historical perspective, we're taking year over year growth periods and actual results that have come in from company that have been reported to the SEC and to our data vendor S&P. So we're able to bring that in, but we're also able to bring in Wall Street analyst estimates, and the estimates are the growth aspect. So as analysts are tuned into what's happening to tariffs and how it's impacting their companies, as they make those changes to their earnings estimates, it will be factored in almost on a real-time basis. However, remember, it's relative. So other companies are making adjustments as well. So if an analyst has to bring their numbers down for a company, analysts are going to be bringing it down for other companies. So you might find for certain companies that the revisions are less than for others. So the beauty of the EPS revisions is it shows you how it's transpiring relative to the sector. So it's not just on an absolute basis, it's on a relative sector. And that's exactly what you want to be able to see during times like this. It separates the strong from the weak because we're looking at everything.
One last question before I stop taking up all your time, because I know I love to do it. The 5 factor grades that we have with the quant system, are those equally weighted when coming up with the buy or strong buy or hold grade, or how does that work?
They are not. So our back test goes back to 2010, but I back test that go back even longer. And I can tell you, not all metrics are created equal. Some metrics are more predictive, whether they fall under the valuation grades or they come under growth or profitability, or even momentum has different time periods. Certain factors have more predictability than others. So within our model, it's not equally weighted. We have a heavier weight on the factors over time that show that they're more predictive.
All right. Now, before we wrap out, I have to say you do have another product here that I love to plug, as well as Alpha Picks. So if you wanted to get more picks from Steve and the quant team here on Seeking Alpha, I would highly encourage you to go check out Alpha Picks. That's 2 stock picks per month. They have an amazing community over there. The returns are quite amazing as well. You can click the link below this video. We have a whole page that describes what that service is. Steve, is there anything that you might want to share about specifically Alpha Picks?
I would say with Alpha Picks, like many of the quant stocks now, they are companies that have very strong fundamentals. They have great businesses, but the common thread, whether it's not even an Alpha Pick stock or not even a quant stock, if it's a good company that's had good financials, it's probably been hit hard. And I know with our Alpha Pick stocks, many of them have been hit hard, but the beauty of it is that the fundamentals continue to remain so strong. And in fact, I think with Alpha Picks, 82% of the companies that just reported had beaten their top and bottom line, which was higher than the S&P, which showed like a 75%. So the fundamentals remain strong, but like the S&P, it's down, but some of these stocks are even down more. And that's really where the opportunity, the uncertainty can really be your friend during this period. As long as you're not scared, the way Peter Lynch mentioned, don't get scared out of the stocks. Or as Warren Buffett has said, be greedy when others are fearful. It's at periods like this that you want to start to accumulate these stocks. And Daniel, the other thing I'll say is really, like when I was looking back in December or January, many companies that had good fundamentals already started to trade off. We started to see the sector rotation very early on. So the market was showing us signs, even as it was hitting new highs. We started to see rotation out of stocks that had strong fundamentals into gold and cash and utilities and REITs and consumer staples. And it's sort of a sign like that. It's kind of like the quant is almost like a Richter scale. When the companies that we have in the quant system start to underperform, it usually means that there's a bigger problem to come. But one of the important things about today was highlighting with the NASDAQ, we're at that point where it's off 15%. And as I mentioned earlier, I really like to look at the S&P at that point where it's off 15%. But that's a good period to start getting into these stocks, because when those major indexes are off 10 or 15%, many of these stocks that have good fundamentals, they're off 20, 30, or 40%. And that's because people had to take profits and go to cash or go to utilities or go to consumer staples. So they sold all these high quality stocks at the same time. And that's why they came off so sharply. That's exactly why if you buy those stocks, as we showed in history during those previous 5 pullbacks, if you bought them at that 15% correction level point, the return was so tremendous holding on to them 2 years later, because investors always return to fundamentals. And then, Daniel, that's about it.
Yeah, well said. I'm also going to leave, and the wise words of my grandmother that once told me is management matters, right? So even though the market goes and does crazy things and oversells off stocks, the companies that you're talking about that have the right management in place that continue to perform always find a way to get that magic back into the markets and into the shareholders' pocket. So, all right, Steve, let's go ahead and wrap it up there. Thank you so much for the top 10 for April here. Can't wait to see how they perform this next month. And everyone, thank you for tuning in, watching this video. Go check out Alpha Picks. And also you can follow Steve on Seeking Alpha as well, where he's always putting out some timely research. Everyone take care, and we'll see you in the next video.